So if I could show you a way to reduce the impact of taxes on your retirement income so you have more money available to pursue your goals, would you be interested in learning more? Of course you would. It's a loaded question. But we're going to go into it anyway so I can share with you some of the tips and the benefits of having proper income planning in retirement. But before I do, subscribe to our channel and hit the notifications bell below so that you're alerted to when we post new videos. In my new book, Don't Outlive Your Money in Retirement, we talk about step number 5, which is to minimize taxes. And it's really more about setting up the income and where it comes from so that you can reduce the impact of taxes. Now, I happen to be a golfer, okay? Some of you may be as well. And we're told over and over again, the shot is going to be good, not because so much how we swung at the ball, but how our alignment and setup is. For those of you golfers, you're nodding like this, right? It's even before you hit the shot. If you don't set it up properly, you're not going to hit it well. Well, the same is true on income planning for your retirement. If you haven't done the proper planning beforehand, you may be putting yourself in a position to pay more taxes than you should. Now, I've been doing this for over 30 years now, and I've defined retirement in terms of 3 different stages. All right? Follow me on this. The first stage is once we've retired up until the point of time where we have to hit the required minimum distribution. Now, up until recently, that required minimum distribution was the age of 70 and a half. I don't know where the half came from. It just was, right? But as a result of the CARES Act, that has been moved up to age 72. So the first stage is from the moment you retire up to age 72. The second stage is where we're still vibrant and active from 72 till some point where we are no longer as active or want to be or can be. And the third stage is where we might not be doing as much. In this video, and with regards to the income planning, I want to focus on the first 2 stages of retirement, before required minimum distributions, and then after, and its impact on taxes and therefore your cash flow. Now, I've talked often about the need to develop an income plan, or if you will, create your own income faucet. The ability to turn on and off this faucet when you need the money. And it all starts with, I talk about it over and over again, it's not about the money management, it's about the planning and the income plan. So understand what money you need coming in, what money is going to go out, and therefore, how much money do you need in addition to that? And it'll either come from part-time work or consulting, or it can come from the portfolio. And if it comes from the portfolio, therein lies the strategies we're going to be talking about today, because it's really important to set this up properly before you start taking the income out. So let's start with that first stage. We've just retired. We're 67 years old, so we're younger than 72, right? And let's say we have $1 million in personal accounts or joint accounts and $1 million in retirement. Or pick whatever numbers you want. And let's say that you've done the income planning and you recognize that you have to generate $50,000 from your portfolio in order to pursue the retirement goals that you have established. So where do you get the money from first? In most scenarios, you would take it from the personal or the joint accounts because the tax rates will be lower on those accounts and taking income from there than they would if you took it all out of the retirement plan accounts. Because what comes out of the retirement plan accounts, everything is taxable at your marginal tax bracket, whereas on the personal or joint account, you could take it out as long-term capital gains, or it could have been sitting in cash in the account, or it could come out as qualified dividends, which costs usually less than your marginal income tax bracket. Now, along these 7 steps that I've outlined in my book, I've talked on a number of occasions about the difference between the accumulation stage while you're working and the distribution stage when you retire. And whereas the whole concept of money management changes when you go from one to the other. Whereas in the accumulation stage, you don't mind taking on a fair amount of risk because you're looking to grow the portfolio. And in the distribution stage or in retirement, you only want to take on the amount of risk necessary to generate the income that you need. So let's say, we had a 70 or 80% allocation to equities, for instance, while we were working because we really wanted to go aggressively and go for the gusto in our portfolio. And now we've created that retirement nest egg. And now we're going to pare down the equity a bit. So here's where the setup comes in. Okay? You really want to own in the personal and joint accounts prior to your required minimum distribution, those investments that could potentially get you the dividend or yield that you're looking for. Because in that way, you don't have to sell anything off. And if you can generate enough in dividends, even at these low rates, then you can pay at a much lower tax bracket than if you were to have to sell off pieces of individual stocks or mutual funds where they could incur either short-term capital gain rates or maybe just long-term capital gain rates. But the bottom line is you want to own more income-oriented investments in the personal account during this stage than the growth ones, because if it's growth, you're going to have to sell off and it may cost you more to get the income that you need, and it may cost you more in the form of more taxes. Once you go to required minimum distributions, and I'll talk about this in just a moment, you have to take a certain amount out of your retirement plans, and therefore you can own more of those dividend places, those investments, bonds, bond funds, whatever, in the retirement plan than in the personal. Because now the money's going to come out of the retirement plan, and it's going to, by definition, regardless of whether it's dividends or growth or long-term capital gain or short-term capital gain, there's no such thing in your retirement plan. It's all taxed at your marginal tax bracket at the time. So the message here is you may want to think about investing a little bit differently in each of the 2 stages, which is investing differently entirely than when you were looking to accumulate money and to manage it aggressively. So if I could show you a way to save almost $9,000 in taxes, would you be interested? Of course you would. So let me share with you this illustration. So this is the benefit of the income faucet. And here the objective is, at required minimum distribution, at age 72, you need to take out $50,000. So your income faucet needs to generate $50,000 annually net to you. And let's assume you have $1 million in your retirement bucket and $1 million in your taxable bucket. Now, you could take out $50,000 completely from the retirement account, and that would satisfy your required minimum distribution, which would be in the vicinity of about 3.6 or 3.7% in total. But because all of it is going to be taxed at your marginal tax bracket, we're going to assume 25% marginal tax bracket, then the taxes owed on the money would be $20,000. That's the wrong approach. Let's take a look at proper planning and using the income faucet in such a way to benefit you and reduce your taxes. And here you would take out the very minimum from your retirement bucket. That would be the required minimum distribution of $36,000. Then you would take out the balance, $14,000, from the taxable account. And because we're assuming 25% on the marginal tax bracket on the retirement account and 15% on qualified dividends, then the taxes owed would be, on this scenario, $11,100. Or, if you will, the benefit of the income faucet planning is $8,900 on your taxes owed. So again, getting back to the golf analogy, right? It's not so much the swing as the setup. Same with the income planning. It's not so much the money management as the setup to when and where we know and how we have to prioritize where and when money is going to come from, and to earmark it properly so we can reduce the impact of taxes. Now, there's another setup you can think about, and I talk about it in the book, and it's the potential of converting or utilizing Roth IRAs. And the Roth IRA can allow you to eliminate the prospects of any taxes when you take money out at a later time. However, you have to pay the taxes up front. And here I would submit to you that depending upon what your objectives are, both from your own planning and from your estate planning, you may want to talk to your tax accountant, your financial advisor, and/or your estate planning attorney to understand whether or not a Roth IRA could help you towards that objective of reducing taxes. Because a Roth is a little bit more complex, but it can be very good at reducing taxes, but you have to understand the strings attached. To learn more about the 7 steps, make sure you watch our playlist, and I truly hope that you enjoy the retirement journey.